inflation remains stubbornly high, posing challenges for policymakers, like the Federal Reserve. Despite indications that inflation might cool down, loose financial conditions persist, contradicting the notion that current policy is restrictive. While the Fed's interest rate target is relatively high, other financial indicators suggest easy conditions, affecting factors like lending standards, bond yields, and stock market levels. Venture capital funding has stabilized, favoring more stable businesses over high-growth ventures. Despite record corporate bond issuance, easy financial conditions continue, suggesting the Fed will maintain higher rates for longer to combat inflation. Additionally, the Fed's reversal of quantitative tightening, QT, may tighten financial conditions later in 2024. However, discussions about slowing QT are underway, indicating the Fed's awareness of impending liquidity challenges. Overall, despite potential tightening ahead, the current environment doesn't warrant rate cuts for liquidity reasons. The resurgence of inflationary pressures demonstrated by consecutive increases in the U.S. Consumer Price Index over the past 3 months challenges the narrative of a controlled economic environment. Even though these increases may seem modest and not align with the Federal Reserve's preferred inflation metrics, they send a clear signal, especially when coupled with robust U.S. retail sales figures. Previously, there was a widespread expectation for significant rate cuts in the U.S., with initial projections suggesting as many as 6 or 7 cuts in 2024. However, these expectations have rapidly dwindled, with markets now anticipating only 1 or 2 cuts, if any at all. This dramatic shift reflects a re-evaluation of economic forecasts and underscores the uncertainty surrounding future monetary policy decisions. The divergence between market perceptions and central bank actions highlights the complexity of the current economic landscape. While investors anticipated swift rate reductions, central bankers hesitated to commit to such aggressive measures, citing the need to maintain inflation stability. This disconnect underscores the challenges faced by policymakers in navigating through uncertain times. The International Monetary Fund, IMF, has heightened its cautionary stance towards the United States regarding its escalating spending and burgeoning debt levels. With inflationary pressures constraining the Federal Reserve from implementing rate cuts, the specter of mounting debt becomes increasingly ominous. The situation is exacerbated by the staggering interest payments on this debt, projected to reach a staggering $1 trillion. Looking ahead, the U.S. faces the daunting task of refinancing a staggering $8.22 trillion next year, with a staggering $17 trillion looming over the subsequent 2 years. This looming debt burden poses significant challenges for the U.S. economy and its ability to sustain long-term fiscal stability. As interest payments consume a larger portion of government expenditure, vital public services and investment may face constraints, potentially hindering economic growth and exacerbating social inequalities. Moreover, the need to refinance such colossal sums places immense strain on financial markets, raising concerns about liquidity and stability. Failure to address these mounting debt obligations could precipitate catastrophic consequences for the U.S. economy and the global financial system as a whole. A loss of investor confidence, triggered by concerns over unsustainable debt levels, could lead to a sharp increase in borrowing costs, further exacerbating the debt burden. This in turn could dampen consumer and business confidence, leading to reduced investment, slower economic growth, and potentially even recessionary conditions. Furthermore, the sheer magnitude of the debt refinancing requirements poses systemic risks, with the potential to trigger financial market disruptions and contagion effects across the global economy. As such, proactive measures to address the U.S.'s fiscal challenges, including prudent spending reforms and efforts to bolster revenue streams, are essential to mitigate the risk of a full-blown debt crisis. Failure to take decisive action could result in a destabilizing spiral of debt accumulation, leading to severe economic dislocation and upheaval. The recent behavior of central banks, particularly the Federal Reserve, has raised eyebrows among economists and market participants. The Fed's decision to hold rates steady while not explicitly pushing back against expectations of imminent rate cuts fueled further speculation and confusion. Some observers argue that central bankers have adopted a more speculative approach, resembling traders rather than traditional guardians of monetary policy stability. Amidst this uncertainty, both bond investors and central bankers find themselves grappling with difficult decisions. While investors may have hedged their bets against a potential recession, few anticipated the extent of the current economic turbulence. Similarly, central bankers acknowledge the complexities of steering monetary policy amidst various global shocks, including supply chain disruptions and geopolitical tensions.